When 95-year-old Warren Buffett makes a financial move this massive, it's not about making more money. It's about surviving what's coming next. And what he's doing right now should make every investor in America reconsider everything they think they know about market safety. I'm Marcus Caldwell, and I've spent 2 decades analyzing institutional money flows. What I'm about to show you isn't speculation. It's a pattern that's played out multiple times in financial history. And right now, that pattern is screaming a warning most investors are completely ignoring. On January 1, 2026, Warren Buffett stepped down as CEO of Berkshire Hathaway after 60 years. But before he left, he positioned the company in a way that tells you everything about what he sees coming: $381.7 billion in cash. That's the largest cash position in corporate history. Let me put that in perspective. Berkshire now holds more cash than the entire market cap of Coca-Cola, more cash than the GDP of Finland or Portugal, more cash than Buffett held during 2008 or the COVID crash. This isn't normal diversification. This is preparation for systemic stress. Here's what makes this extraordinary. Buffett hasn't just been building cash. He's been systematically selling stocks for 12 consecutive quarters. From Q4 2022 through Q3 2025, Berkshire sold more than it bought every single quarter. The total? $184 billion in net stock sales. That's not because these companies failed. It's because valuations reached levels where he couldn't justify deploying capital at prevailing prices. When prices don't reflect value, Buffett stops buying. It's that simple and that disciplined. Look at what he sold. Apple, his favorite stock. Berkshire owned over 900 million shares at peak. Today, it owns 238 million. He sold 74% of the position. Not because Apple is failing, because Apple got too expensive relative to intrinsic value. Bank of America, trimmed by 26.3 million shares in Q3 2025 alone. These aren't stocks Buffett dislikes. These are stocks he loves that became overvalued. When Buffett loves a company but sells anyway, that's a signal about market pricing, not company quality. Before I show you what this means for your portfolio, if this analysis is valuable, hit that subscribe button and turn on notifications. This channel gives you institutional-level intelligence Wall Street doesn't want retail investors to have. Your subscription supports independent analysis free from conflicts of interest. Now let's examine what the data is telling us. The S&P 500 Shiller CAPE ratio hit 40 in November 2025. The CAPE ratio measures market valuation by comparing prices to 10-year average earnings adjusted for inflation. A CAPE of 40 has only been exceeded twice in history, once during the dot-com bubble in '99. Once during the COVID peak in early 21. Both times were followed by massive corrections. The dot-com crash took NASDAQ down 80%. The COVID correction brought markets down 34% in 3 weeks. Historical data shows that when CAPE reaches 40, markets typically decline 30% over the next 3 years. That's not prediction. That's pattern recognition from over a century of data. Buffett sees this pattern clearly. The market is completely ignoring it. Here's where it gets revealing. Buffett didn't just sell stocks. He stopped buying Berkshire stock too. For the first 9 months of 2025, 0 share buybacks. None. Buffett always said he'll buy back shares when they trade below intrinsic value. The stock fell 14% from May to August 2025, a massive opportunity if he thought it was undervalued. He bought nothing. That tells you he believes even Berkshire, the company he built, the stock he knows better than any analyst, isn't cheap enough at current prices. If Berkshire isn't worth buying, what is? That's the question every investor should ask right now. Meanwhile, the cash kept climbing. $105 billion in 2022, $150 billion during COVID, now $381 billion, more than double the previous peak. The cash position now exceeds Berkshire's entire stock portfolio. $267 billion in stocks, $381 billion in cash. The man who built his fortune buying companies at fair prices now holds more cash than stocks. He's positioned for defense, not offense. Cash serves two critical functions during market crashes. First, it preserves capital when markets fall 30 to 50%. Second, it provides opportunity when everyone else is forced to sell. Buffett learned this in 2008. He's preparing to use it again. Let me take you back to that crisis because the pattern matters. Before Lehman collapsed, Buffett was selling stocks and building cash in 2007, while markets hit record highs. Investors complained he was missing the boom, that he'd lost his touch. Then September 2008 arrived. Lehman failed, credit froze, stocks fell 50%, and Buffett, sitting on massive cash, became the lender of last resort. Goldman Sachs, $10 billion at 10% plus warrants. General Electric, $3 billion at the same terms. Bank of America, $5 billion in preferred stock paying 6%. These investments generated billions because Buffett had cash when everyone desperately needed it. The people who mocked his caution in 2007 spent years recovering. Buffett spent years compounding wealth at extraordinary rates. That's the pattern. Buffett doesn't predict crashes. He positions for them. Now let's examine what this means for your portfolio. If you're invested now, understand what you're betting on. You're betting CAPE at 40 is justified by future growth that hasn't happened yet. You're betting profit margins at record highs stay there indefinitely. Your betting rates don't spike. Credit doesn't tighten. Growth continues smoothly. You're betting A. I generates the trillions current prices assume. Some bets might pay off, but all of them must pay off simultaneously for current valuations to make sense. Buffett is betting they don't. If you're saving for retirement, think about sequence risk. You might lose 20 to 40% in a correction. If you're 60 planning to retire at 65, that changes everything. Recovery might take 5 to 7 years historically. You might be 70 before your portfolio returns to 60. The 2008 crash took 5 years to recover. The dot-com crash took 13 years for NASDAQ to return to peak. Buffett is positioning to avoid that pain entirely. Markets have been expensive before and kept rising, you're thinking. CAPE hit 40 in late 2019 and markets climbed. Why is this different? The answer is context. In 2019, rates were near zero. The Fed was supporting markets through massive QE. Earnings were growing steadily. In 2025, that backdrop no longer exists. Rates are above 5%. The Fed is shrinking its balance sheet, removing liquidity. Earnings growth is slowing as margins face pressure. The conditions that justified high valuations during COVID simply aren't present anymore. Buffett sees that reality clearly. The market hasn't adjusted yet. That's what makes this a critical positioning moment. Here's what Buffett is betting on. He's not betting stocks crash immediately. He's betting valuations will adjust over the next few years to reflect slower growth and higher rates. When that happens, wonderful companies will trade at prices that make sense, and he'll deploy that cash systematically at fair or cheap prices. He's waiting for the right pitch. Right now, the market isn't throwing strikes. It's throwing overpriced pitches Buffett refuses to swing at. His discipline in waiting separates legendary investors from everyone else. This isn't about cash sitting idle. Berkshire generated $13.5 billion in operating earnings in Q3 2025. That's 34% growth year over year. Insurance profits tripled to $2.4 billion. The insurance float reached $176 billion. BNSF Railroad generated $1.4 billion quarterly. Berkshire Energy produced $1.5 billion. Manufacturing and services contributed $3.6 billion. Real businesses generating real profits regardless of stock valuations. This isn't a hedge fund waiting for crashes. This is an industrial conglomerate run by someone who understands market cycles better than anyone alive. The businesses perform as designed while cash accumulates. Think about what that means. Berkshire generates roughly $50 billion in operating earnings annually. After expenses and taxes, tens of billions remain. Normally, that would buy stocks or fund acquisitions. Instead, it's accumulating because Buffett would rather earn 5% in treasuries than overpay for stocks. That discipline separates great investors from average ones. Average investors feel pressure to deploy cash constantly. Great investors wait for prices that make sense. On December 31st, Buffett officially stepped down. Greg Abel took over January 1st, 2026. This timing matters. Buffett wouldn't hand over control if the next years required aggressive buying in smooth markets. He handed over after building the defensive position. What comes next? Deploying cash during distress or managing through turbulence? That's Abel's job. Buffett positioned the company. Abel inherits the strongest balance sheet in America exactly when it might matter most. Here's what you should do with this information. First, understand your risk tolerance and timeline. 5 years from retirement and heavily invested, you're exposed to serious sequence risk. 30 years out, short-term volatility matters less. Your actions should reflect your specific situation. Second, consider if you're comfortable with current valuations. If you think CAPE at 40 is sustainable, stay invested. If you think it will mean revert, consider reducing exposure. Alignment between beliefs and portfolio matters. Third, build cash reserves if you don't have them. Not because the markets will definitely crash, but because having liquidity when opportunities arrive changes everything. Buffett can make extraordinary investments during panics precisely because he held cash while everyone else was fully invested. You can't replicate Berkshire's scale, but you can replicate the logic. Fourth, stop assuming stocks always go up. NASDAQ peaked March 2000 at 5,048. Didn't exceed that until April 2015. 15 years of zero gains. 15 years during prime earning or retirement years cannot be recovered. Buffett knows this reality. The market acts like it doesn't exist. Fifth, recognize legendary investors avoid catastrophic losses, not chase returns. Buffett at 95 has nothing to prove. He could deploy $381 billion tomorrow if markets keep rising. He's choosing not to. That choice carries more weight than any analyst report. This isn't pessimism. This is preparation. Smart money builds fortresses when everyone else is euphoric. And when opportunity arrives, it acts decisively while others are paralyzed. $381 billion in cash, $267 billion in stocks, 0 buybacks despite weakness, 12 straight quarters of selling, a new CEO inheriting the strongest balance sheet in corporate history, book value per share at $485,000 per Class A share, an 11% increase year over year. Over 60 years, book value compounded at 18.3% annually. The S&P averaged 10.4%. Berkshire outperformed by 8 percentage points annually for 6 decades. That's not luck. That's systematic edge from discipline. The source is simple but difficult to execute. Buy quality at reasonable prices. Hold forever unless fundamentals change. Don't overpay regardless of enthusiasm. Wait for opportunities even if it takes years. That discipline built 502,000% cumulative return since '65. 10,000 became 50 million by 2024. The same in S&P became 390,000. The difference is discipline. The discipline to say no when prices are wrong. Here's what most miss about cash. Cash isn't a crash bet. It's recognition that at Cape 40 expected stock returns don't justify risk versus alternatives. If stocks offer 3 to 4% expected return and treasuries yield 4 to 5% risk-free, why take equity risk? That's not timing. That's math. Warren Buffett's bet at 95 isn't against America. It's against current valuations. The bet is that patience will be rewarded when prices adjust to reality instead of AI hype. That might take months or years. But Buffett has time. He built a company to outlive him. He installed a CEO who shares his philosophy. He positioned the balance sheet to wait as long as necessary. And when opportunities arrive, Berkshire will buy systematically like every past crisis. The biggest lesson isn't what Buffett's doing. It's why. He's not reacting to fear or predicting doom. He's refusing to overpay regardless of what markets do. When businesses trade at fair prices, he buys. When they're expensive, he waits. Right now, he's waiting with record discipline. Warren Buffett made his biggest bet ever. 381 billion betting patience beats chasing returns at any price. That contradicts everything current markets believe. One will be proven right, one wrong. Which side do you want to be on? Because when this divergence resolves, investors positioned correctly will preserve and grow wealth. Those positioned incorrectly will spend years recovering, and the opportunity to prepare will be gone. Buffett is preparing now while others chase AI stocks, while confidence is high and fear is absent, while everyone assumes good times continue forever. That's when Buffett always prepares. That's why his 60-year track record speaks louder than any rally. The biggest bet isn't buying, it's waiting. Waiting with 13.5 billion quarterly earnings. Waiting with 176 billion in float. Waiting with 381 billion ready to deploy when prices make sense. At 95, Buffett showed you what preparation looks like when you have nothing to prove and everything to protect. The fortress is built. The cash is ready. The discipline holds. The next chapter will prove whether euphoric markets or disciplined capital allocation understood reality better. History says bet on Buffett. Markets say bet on momentum. Choose wisely because one perspective will define your next decade. If this helped you think differently, hit that like button and share with investors who need to see what the smartest money is doing. Thanks for watching The Equity Edge. I'm Marcus Caldwell, and I'll see you in the next one.